If you leave $100,000 sitting in a standard savings account, it is not stable. It is actively disappearing. Think of inflation as financial entropy. Financial entropy is the concept that inflation acts as an active, corrosive thermodynamic force on idle capital. When inflation runs at an average of 3%, money left untouched is mathematically deteriorating. Look at this ledger. Over a single decade of inaction, that $100,000 loses roughly 26% of its purchasing power, leaving you with the equivalent of $74,000. People leave their savings entirely in cash because they fear losing money in the market. But by doing nothing to protect that cash from inflation, they are locking in a guaranteed, unrecoverable loss. Because of this structural decay, treating your capital as a fragile possession to be hidden away is mathematically irrational. Instead of a static possession, capital is a raw resource waiting to be deployed. An amateur hoards money out of fear and watches it slowly erode. A financial operator views that same capital as a working engine, capable of generating its own output. The mechanism that separates these two mindsets is a rules-based architecture. A rules-based architecture is a systemic framework designed specifically to extract human emotion entirely from the point of decision-making. Achieving financial independence requires the structural discipline to build this automated machine, step back, and let it run. To build the first module of the system, we have to isolate how we process risk. Humans instinctively treat financial risk the same way they treat physical danger, as an emotional source of anxiety to be avoided. This leads to a binary reaction. People either avoid risk entirely, which guarantees inflation losses, or they embrace it recklessly without calculating the downside. Both extremes are forms of financial ignorance. The alternative is structural allocation. Structural allocation is the practice of dividing your portfolio between high-return and low-return assets to manage exposure. Here, risk becomes a precise, manageable variable. You must calculate the stability needed so that when the market drops, you aren't forced to sell. Look at the stability buffer on this slider. A 30% drop is a statistical probability your baseline structure must absorb. An intelligent investor never eliminates risk. They calibrate it. They ensure the expected mathematical reward always justifies the mathematical exposure. Even with a calibrated portfolio, two behavioral biases act as portfolio killers. Loss aversion, which causes you to hold on to losing positions too long, and recency bias, which drives you to buy on hype and sell on fear. These biases lead to compounding interruption. Compounding interruption is the act of resetting the exponential growth cycle of an asset by emotionally intervening and selling prematurely. This chart maps 30 years of behavioral data. Line A represents an aggressive investor who frequently trades on emotion. Line B represents a methodical, passive investor who maintains a steady allocation. Despite chasing a 14% yield, the aggressive investor's friction and panic selling leave them with approximately $300,000. Now watch the methodical investor's trajectory. Consistency and zero interruptions compound their capital to $1.7 million. The underlying mechanism here is that the vast majority of compounding growth occurs in the final years of the curve.
Resetting the clock early on destroys that late-stage momentum. The ultimate enemy of wealth generation is not low market returns, it is the human interruption of the mathematical process. To prevent that interruption, you need to build a mechanized system that bypasses your own motivation and guarantees the strategy is executed. Step 1 is structural discipline. You must automatically extract and invest your contributions before the capital ever reaches your checking account. You cannot rely on feeling motivated. The architecture of your accounts must move the money forcefully. Step 2 is defining your preset rules. You have to write your investment algorithm in advance, during a period when you are calm and rational. This is an entry-exit framework. An entry-exit framework is a rigid set of instructions that uses strict logic gates instead of human judgment to manage positions. During extreme volatility, this framework dictates exactly what conditions trigger a rebalance. Notice how the system responds to a simulated crash. It automatically triggers the then pathway. The human being is not consulted, because instinct under pressure is unreliable. If the rule dictates a hold, the portfolio is held. If it dictates an exit, the position is closed without hesitation.
This automated precision stands in sharp contrast to the traditional retail investor, who frantically checks financial news to decide what to do next. High intelligence without a rigid, rules-based algorithm is simply a faster path to making sophisticated, emotional mistakes. The objective of this algorithm is not simply to generate high returns. The objective is structural financial independence. This requires building a passive income architecture. Passive income architecture is the specific structural threshold where your assets generate more annual income than your lifestyle requires, effectively replacing your active labor. The mathematics here rely on scale. A 10% return on a $100,000 base yields $10,000 a year, which is insufficient for independence. In the early stages, the strategy is to aggressively reinvest all of those outputs back into the base, which rapidly scales the engine's size. As the base capital hits $1 million, that same 10% return generates $100,000 annually, shifting the nature of the math. Financial independence is the structural result of an architecture where money operates autonomously, replacing the need to trade time for income. This raises a final paradox. If a managed portfolio is enough to set someone free, why do so many highly intelligent, high-earning professionals remain financially trapped after decades of work? The answer lies in what they optimize for. A high earner who optimizes for immediate consumption will always be structurally weaker than a lower earner who systematically converts their income into a compounding machine. The required behavioral commitments are clear. You must treat your capital as a working system, protect the compounding cycle from your own emotions, and calibrate your risk mathematically. Executing this does not require genius, complex financial tools, or exclusive access to private markets. A $100,000 portfolio serves as the primary input for a rational, logical process that makes lifelong financial independence a mathematical certainty.